Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. President Trump is threatening to hike tariffs on South Korean goods from 15% to 25%. The president cited the failure of South Korea's legislature to approve the U.S. trade deal. Here is Bloomberg's Josh Wingrove.
He's essentially ripping up, or at least for now, the deal and saying that's because the Koreans are slow walking it. I should note that there were a lot of question marks, including from what the American position was about this deal. We still, for instance, don't know what the shipbuilding cooperation will look like. And so this is another case for countries that are looking at this, including the EU and the UK that had their deals and that then saw the Greenland tariff threat come in. The Trump's deals aren't necessarily, locked in.
That is Bloomberg's Josh Wingrove. Needless to say, if they are implemented, these tariffs could have a wide-ranging impact on major South Korean companies that export to the U.S., such as Hyundai Motor. Insofar as the overall South Korean equity market is concerned this week, it's an important week for earnings. We'll hear from Samsung and SK Hynix. For a closer look, I'm joined by Bloomberg's Youkyung Lee. She covers South Korean equities from our bureau in Seoul. Thank you for being here. Can we start with Samsung? Give me a sense of what the market is expecting to hear.
The market is very intently focused on Samsung's semiconductor business and what they're going to say about the current demand and the future demand forecast for the semiconductor, especially the memory area. Earlier in January, Samsung already has given preliminary earnings saying that the fourth quarter of 2025 will see record operating profit. That's almost triple from a year ago. And now investors are going to ask Samsung about how they see the coming year. What they're curious about is especially how much they're going to hike the memory prices. You probably have heard that the world is experiencing shortages in memory chips because there's so much demand coming from artificial intelligence applications and data centers. And these memory chip sectors are dominated by these Korean companies. Two of the world's three largest memory chip makers are located in South Korea, and Samsung is the biggest among the three. So investors are really, really curious about what Samsung is going to say about the outlook for the memory demand and how much price premiums they're getting from their customers and how much memory chips they have sold in advance. These kind of stuff are going to be the key questions that the analysts and investors are going to ask.
So where AI kind of intersects the memory market, that's the high bandwidth memory chips that are used as a part of the AI functions. You mentioned the competitors that Samsung has in Seoul, two companies. I'm thinking of SK Hynix in particular. Do you think the results from Hynix will pretty much mirror what we hear from the chip side of Samsung?
Yeah, I think it's going to mirror what people hear from Samsung. And interestingly, this time, Samsung and SK Hynix are releasing their earnings on the same day on Thursday. This is quite unusual. But when it comes to memory chips, both of them are dominant memory chip maker, but what they excel at are a little bit different. Samsung is dominant supplier of the conventional memory chips that's called DRAM that's currently seeing shortages and huge price hikes because memory chip makers have been reducing their supply to make more advanced chips. So these type of conventional commodity DRAM that used to be cyclical are now seeing huge price hikes. And this is the area that Samsung dominates and also SK Hynix provides and Micron provides. But when it comes to SK Hynix, is the dominant supplier of the high bandwidth memory chips. Investors are definitely going to more focus on this HBM products, like how advanced they are and how's the race is going to look like. Currently, SK Hynix has been seen as having an edge over Samsung in this race to supply the HBM to NVIDIA and other companies. But people think that Samsung is getting close to catch up with SK Hynix. So this rivalry between Samsung and SK Hynix when it comes to this type of HBM product that's really key to this AI race is also going to be the focus during the earnings conference call for SK Hynix.
Youkyung, we know that the South Korean equity market really is very much a reflection of tech industries. And recently, the benchmark Kospi was able to break above 5,000 for the very first time. This is something that the South Korean President Lee Jae-myung has set as a goal, whether we're talking about chips or more broadly other types of high-tech technology. Is the president's office really trying to support more growth?
Absolutely. So when current president came into office in June of last year, there were expectations that he may not be as pro-growth because he was seen as leftist. But to the surprise of the market, he was a lot more pro-growth than most investors had expected. So President Lee's office has been coming up with this idea of $150 trillion worth AI fund that would boost innovation and the future AI technology for South Korean companies. And that has been received very positively by investors and also by the local companies. So these type of initiatives show how President Lee's office is trying to boost innovation and growth through the future technologies such as AI and robotics. President Lee's office has definitely been very pro-growth, and these has been one of the two pillars, along with corporate governance reform, that his office has been trying to promote.
So we were talking a moment ago about the supply constraints of memory chips, and I'm wondering whether or not that necessarily means that memory prices are headed higher, and that for that reason, whether we're talking about Samsung or SK Hynix, that their margins will likely improve going forward. Is that a safe bet?
This is an absolutely safe bet, and investors who have made such wagers from a few months ago have been making a lot of money. And I think the market is still catching up with this narrative, how much the memory prices are in short supply and how much a price hike is going to be. Recently, a Samsung executive told Bloomberg that this is going to affect everyone from consumers, and nobody's going to be safe from this upcoming memory price hikes because everybody uses all the devices that have memory in it. And this is a huge change from the past when memory chips were considered to be commodity. They were very, very sensitive to supply and demand balance. And this is type of a supply demand imbalance that we have not seen in a few years. And that is because so many memory makers have been using their production lines to produce the higher end memory chips that are for the AI. So they have been running out of place to produce more conventional, cheaper DRAM. Now those cheaper DRAMs are no longer as cheap as before. So during the fourth quarter of last year, companies have been reporting a huge price hikes in the memory chips. And I heard like clients are willing to pay so much premiums to get the memory because these memories are actually what they also need to have the artificial intelligence related data centers and apps up and running. So we've seen huge price hike during the fourth quarter of last year, but most people in the market expect these memory price hikes to continue and possibly even at a stronger rate than we've seen before. And this is something that's really been exciting to the investors in Samsung and SK Hynix because these companies used to be seen as cyclical stocks, meaning they have cycles of ups and downs. But a lot of these investors are now seeing that these companies would be less sensitive to these cycles of the industry because of the memory chip price hikes that we don't know when it's going to end. A lot of the analysts have been saying that such memory imbalance could continue through 2026 and possibly 27. So there are expectations that such memory price hikes will go on for a while, and it's going to affect consumers around the world who's going to buy the phones or PCs or other mobile devices.
Youkyung, we'll leave it there. Thank you so very much helping us understand what's at play in the memory chip market as we look forward to earnings in the week ahead from both Samsung and SK Hynix. Bloomberg's Youkyung Lee, she covers South Korean equities from our bureau in Seoul, joining us here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. This week, we'll get earnings from 4 of the Magnificent 7. We'll hear from Microsoft, along with Meta Platforms and Tesla. Those numbers will hit the tape on Wednesday. Thursday, we will hear from Apple. Now, these results will offer a glimpse into business from cloud computing and electronic devices to software and digital advertising. For a closer look, I'm joined by Zachary Hill. Zach is head of portfolio management at Horizon, and he is on the line from Charlotte, North Carolina. Thank you for being here, Zach. What are your expectations in terms of the earnings that we're going to be getting this week?
Great to be with you, Doug. I mean, I think in terms of the Mag 7, what we're going to be watching, one is CapEx plans. Obviously that's been an on again, off again subject for the market. And we do think that's going to be scrutinized by investors, especially given some of the lack of momentum that we saw kicked off by, last earnings season in October. So that's one area of focus. And the second one is going to be around margins. As these companies are investing, investors are going to want to see that they have revenue growth and they can maintain their margins in the face of that. So those are the two things for the top of the market that we're going to be watching this week.
Yeah, it's interesting you make the point about margins. Apple's numbers on Thursday probably will tell a lot about the pressure that this company may be facing when it comes to memory. There seems to be a shortage right now of memory chips globally.
Yeah, I mean, that's definitely been moving some of the sort of AI adjacent names, not in the Mag 7, more recently. But I think more broadly, as we zoom out, the fact that this cohort of stocks that has really led the market for the last few years is not moving as a monolithic group is really, the most important development for investors. And so we're going to be picking through, these reports this week, just like everybody else. But I think we've gone from the stage of, the AI trade being a sort of a beta trade, a blanket buy, to a little bit more of an alpha stock picking type environment.
What do you make of the trade in precious metals? Today, as an example, we had silver rallying to a record high. At one point, I think we were at $117 an ounce.
Yeah, I mean, it's really been something, to take any of your expectations and blow them out of the water. Silver today, I think we pulled back 14% from the highs or something like that. I mean, volatility is extraordinarily elevated. I mean, generally speaking, Doug, look, we completely sympathize with this idea. There are fewer safe assets in the world today than there were in the last 5, 10, or 20 years. And so that does kind of force long-term holders that are looking to preserve purchasing power into real assets, and certainly precious metals are part of that, have been for a long, long time. Right here, as we said, we think that the risk reward of chasing some of this action and the volatility we're seeing in markets is not very favorable right now. And so we would rather, position portfolios to benefit from a weaker dollar and have some exposure to commodity producers, but, not direct within the commodities themselves, given the overall volatility we've seen.
To what extent is this about politics? I mean, if you see investors moving out of things like sovereign bonds or even currencies and into havens like the precious metals, is this really a statement about uneasiness with the current trajectory of the political landscape?
I think it's a reflection of certainly a realization that people are coming to, that it's a little bit of a different environment where there are more things on the table than there had been in the past. And so, over the last year, I think we were really blindsided by a lot of that. But, the cat's out of the bag at this point. And so, on the margin, we do see some changes in behavior that are starting to occur. It's not a wholesale, shun all U.S. assets or completely reorient your portfolio, but it does, sort of tilt the balance of risk in favor of some parts of the market and some exposures that have been underperformers for, not just the last 3 years, but really for the last decade. And so we do think that's a notable development that we're watching quite closely.
So staying with this theme of politics, we have President Trump and Senate Democrats. They appear to be headed towards some type of government shutdown, maybe. There's been a lot of revolt on the part of Democrats, particularly in the Senate, against funding the Department of Homeland Security without new safeguards. Obviously, that's after the killing of a U.S. citizen in Minneapolis by federal agents. Is there a real risk in your mind that we could get another government shutdown?
I think if we do, it's going to be partial. Right now the talk is about splitting the continuing resolutions apart and doing them in pieces. And so I think the market does expect to have a shutdown this weekend, but I think belief is going to be, short and shallow, not like the one that we just had. And certainly, as macro investors that are trying to parse the data like everybody else, we hope that's the case. Generally speaking, investors have looked through this type of volatility, and we do expect that to be the case. But look, we've been flying blind on, how the economy is orienting itself for quite some time. We were just starting to catch back up. So even a little disruption there could be, pretty difficult.
I think the same could be said for the Fed in terms of flying blind, right? And we've got a rate decision this week. The Fed is widely expected to keep rates unchanged in the face of calls from President Trump to lower rates. How do you view the Fed's role in what we're seeing unfold these days?
I mean, I think they want to be as out of the headlines as they possibly can be. That's hard to do these days, but we do think the Fed is on pause. They've cut 175 basis points from the high. We don't know where neutral rates are. Nobody really knows where neutral rates are until after the fact, but it is categorically true that we are closer to them today than we were a year or 2 years ago. And so, there's been a lot of insurance taken out. And so we think the Fed is going to try to fly under the radar, for as long as possible. Everyone likes to watch the Fed, so that switches the drama to, the Fed chair and that race as opposed to what they're doing with short-term interest rates. That
said, there's still policy risk when it comes to U.S. insurance companies. I mean, after the bell today, we had word from the government that they intend, or it intends, to hold payments to private Medicare plans flat next year. Many of the analysts that we spoke with were expecting an increase in payments by as much as 6%. So I'm looking at shares in many of the major U.S. health insurance companies down quite a bit in late New York trading. What are the other areas where the administration represents a bit of policy risk to publicly traded companies? Is it something beyond healthcare in your mind?
Yeah, I mean, I think we've seen a willingness to, be more, muscular in terms of intervention in markets across a lot of sectors. I mean, just, if we were having this conversation a week or two ago, we would have been talking about the cap on credit card rates and what that's done to some credit card issuers. And certainly we're going to be, listening to what Visa and MasterCard have to say, as they report earnings this week. But I think, broadly, it's just kind of getting back to that idea of the range of possibilities is broader than it was in the past. And so, investors need to, think about reallocating their portfolios, be more diversified, look for opportunities that are kind of out of the news and position that way, as opposed to trying to chase these headlines, which can be a really challenging thing, as we saw last year.
Are small cap stocks part of that strategy? I mean, if you think that the economy is going to do reasonably well, valuations in the small cap arena may be attractive, and certainly they haven't been headline grabbing necessarily. Would the small cap space be something that you're looking at right now?
That's an area that we have been looking at. We've quite frankly been a little skeptical on this rally. We've been more optimistic about, growth in 2026. And as we think about the different ways to express that, small caps were certainly on the menu. But given the, amount of head fakes that we've seen in that part of the market and just how low quality they are on an index basis, we preferred to have our exposure across the cap spectrum in the banks in the U.S. And then also looking internationally for some natural resources and some smaller cap companies there that have that, commodity gearing. We're watching the move in small caps, and certainly if we see a big pullback that looks attractive to us, we may change our stance. But right now, we're a little bit cautious on that very hot sector of the market.
What about opportunities offshore? Are you finding any?
Oh, for sure. I mean, I do think that, flat to lower dollar is something that we're going to be, that regime is going to persist for some time. That's not something that investors are really used to. And so we do like international stocks for that reason. And if you like, if you think that we're going to have a higher global growth environment in 2026, and certainly we do, you have a lot more cyclically and value-oriented companies that trade a lot cheaper than they do in the U.S. And so that's been a core, way we've tilted portfolios over the last year, and we're continuing to do that into the first month of this year.
Zach, we'll leave it there. It's always a pleasure. Zachary Hill is head of portfolio management at Horizon, joining from Charlotte, North Carolina, here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.